And so most people, when they think about trading and they bring up the, casino, they think of gambling. They think, oh, trading is just gambling. There's no skill to it. There's no statistical edge. That can be far from the truth when you're dealing with options. It is actually not only far from the truth, it's not the truth. When you are the primary option seller, you are the casino. No one that has any understanding of how casinos work would say casinos do not have the odds on their side, that they're just gambling. No one will say that, and if they did and you heard it, you would think they're an idiot. Here, and let's talk about the basics of options and why it is super important to be the primary option seller. Now, obviously, you guys know here at Dorian Trader, we're primary option sellers. So obviously, we have a bias, we're leaning a certain direction, but it's a statistical edge. It's a probabilistic reason why we are the primary option seller. And so it's about understanding the basis of options, and you'll be able to understand that very quickly, at least once you get the first pillar down of the base of options. Here at Dorian Trader, we believe it's three pillars to the base of options. The first pillar is what we're going to be talking about. What is a call and a put, and what's happening when you sell a call and a put. The second pillar is the options chain. As you can see on your screen right now, this is the option chain. It's important to understand how the option chain operates, which direction it's going. Are you at the money, in the money, out of the money, where your delta is located, things like that. It's very important to understand about the option chain. And then the third pillar is understanding basic option strategies, because as you heard me say several times in the past, if you understand the basic option strategy, you'll be able to understand all the different exotic strategies that are dreamt up out there because they're just deviations from the basic strategies. But let's focus on pillar number one, understanding what's happening when you buy and sell a call and a put. And once you do that, you'll understand why it's important to be a primary option seller. When you are learning about options, it's important to try to step outside of the kind of technical terminology, the textbook type of definitions, at least for a second, so you can kind of have a 10,000-foot view or understanding of options. The way we try to do it here at Dorian Trader is talking about three different type of analogies, three different type of examples, so you can understand the base of options. The primary way we talk about is an insurance company, because it mirrors options almost 100%. The insurance industry, like the Geicos, the Progressives of the world, the way they operate their business, it's almost 100% the way options work. For example, if you are the buyer of an insurance policy, you go into Geico and you're buying car insurance, you're going to pay them a premium. You're going to pay them monies that's called a premium for a policy. They're going to dictate that policy. They're going to determine how much to charge you, how much you have to pay in premium, because they control that. They control all aspects of the contract. You don't have to agree on it, but they control that contract. And so most of us already know intuitively that the insurance company has the odds on their side. And the reason why they have the odds on their side is because they get to dictate everything. If you are someone that's very risky as a driver because you have speeding tickets, DUIs, crashes, they can decide what amount to charge you because of that fact, or to even insure you at all. They do their due diligence, understand the risk, and charge you accordingly. And so most months you're going to be losing money paying your insurance. Most years you're going to be losing money to that insurance company. And if you get into an accident and let's say your car is completely totaled, okay, maybe the insurance company loses on you at that point. But for them, that's like a bad trade. For us, it's like a bad trade. You're going to lose on some trades as long as your losses don't supersede the premium that you bring in. And that's exactly what's happening with insurance companies. They understand it's going to be claims against them. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. back to the video. But what is really interesting about insurance companies, just like the market, is that if you get in an accident and your car is completely totaled or an accident, period, your volatility increases for them if you think it in an options terminology. And so they're going to charge you more premium, your next policy. They're going to reflect that you are now riskier. And if you're trading options and something goes completely wrong, let's say things get more risky out there, well, the premium is going to reflect that. You're going to be able to get more premium for selling those policies now, selling those options now. So you want to be the insurance company, primarily when you're dealing with options, when you're trading options. Is it a time to buy sometime? Yes. Even Geico, even Progressive buys insurance. They go to what is called reinsurance companies to hedge out some of their risk. And they do it before hurricanes happen. They do it before the problem hits. Some of you know that a number of insurance companies were bailing out of California, and they were bailing out before the recent fires because they deemed the risk too great. You, as an option seller, can do the same thing. You can sell options that give you an 80% chance of winning, or you can sell options that give you a 99% chance of winning. You can decide. Obviously, if you have a 99% chance of winning, you're not going to make a ton of money. Insurance companies make less on people who they deem really, really safe because they're going to charge less. It's another knowledge that we talk about when we talk about the casino. And so most people, when they think about trading and they bring up the casino, they think of gambling. They think, oh, trading is just gambling. There's no skill to it. There's no statistical edge. That can be far from the truth when you're dealing with options. It is actually not only far from the truth, it's not the truth. When you are the primary option seller, you are the casino. No one that has any understanding of how casinos work would say casinos do not have the odds on their side, that they're just gambling. No one will say that, and if they did and you heard it, you would think they're an idiot. It's literally the same thing with options. You have an edge. You have a probabilistic edge when you're trading options. You are the house. You are the casino going up against the people sitting at your blackjack table. You can decide, just like the casinos, if someone's winning too much, you can stop them from playing. In your case, if you're losing too much on an underlining because some reason you don't have, it's just not working out, the probability is not working out, you can stop trading that underlining. You have that ability. And I can go on to a number of different, examples on why the option seller is the casino, why it's the house. But let's talk about the third analogy that I like to use, and it's the landlord. When you are the option seller, you can be the landlord, or you're acting as the landlord. Most of us want to be the owner of the property instead of paying the owner, at least for an investment property, your own house. And you understand that, man, you got maintenance and more maintenance, right? Sometimes it just feels a little easier just to rent and have someone else deal with the issues that come up. But anyway, when you own at least 100 shares, your shares become a property in essence. You can rent it out. You can rent it out like a vacation rental. You can rent it out like an Airbnb. You can rent it out the traditional way of doing something for 30 to 12-month type of lease. You can rent your shares out and get paid for it just like you can for a property. You can do what it's called rent to own. They have the right to purchase your house, or in this case, your shares, at a certain price within a certain time frame. It's always an expiration period when you're dealing with options. If it doesn't reach that certain price, then they will not have the right to buy your house unless they decide to just buy it anyway at the price that you specified. If they don't, the contract ends and you can do it all over again. You can rent out your shares on a weekly, monthly, quarterly, yearly basis. And it can be crazy safe if you're using our safeguard strategy. Using our safeguard strategy to sell covered calls and or collars. You're renting out your shares. When you are the buyer, right? When you're the person going to the insurance company, when you're the person sitting at the blackjack table, going against the house, going up against the casino, when you're the person, and when you're going to rent the house, you have the odds against you. It's clear as the insurance analogy. It's clear with the casino. It might not be clear to you as the landlord, but if you're going up against the landlord, but you do have the odds against you. The landlord can decide to change the rent requirements or the contract requirements after every expiration. And most of you who have rented in the past, of all of us who have rented at some point in the past, know that the landlord can increase the rent after every leasing period. And most do. If you're in a place and they decide that they want to sell the house, then you have to vacate the place. You have to start looking for another one because they control that. They have the odds on their side. So if you're the buyer, you're all of that is against you. If you're the buyer of a single option, you have at best a 50-50 shot or coin flipping chance of winning. But almost 100% of the time, if you're the buyer of a single option, it's less than 50-50 at expiration. And option probabilities are based at expiration. So you have the odds against you almost 100% of the time when you purchase an option, because you not only have to get the direction right to supersede the premium that you paid on that policy, you have to get it right in enough time. You have to get it right fast enough. The time is ticking. So something that's called theta. Time is ticking every day. And as a primary buyer of options, you have what is called negative theta. That means time is your enemy. Time is going against you. You need the move to happen and happen fast. If you're the primary option seller, time is your ally. If nothing happens, you still win. If something happens that's not too big, that's not too huge, you still win. Especially the way we teach here at Dorian Trader. Being the primary option seller is the way you want to be. And you buy sometime when you're trying to hit a home run, trying to hit a grand slam, and when you're trying to protect yourself, just like insurance companies do.